returning to that, yeah.
Okay, good morning. I want to call to order the July meeting of the Police Pension and Relief Fund. Bruce couldn't be with us today, and so he asked me to chair the meeting. He actually thought he would just be running late, but he found out that his son also has a dental appointment following his first appointment this morning, so unless this meeting runs long, we're not likely to see him this morning. So he apologizes, and we'll move forward. So, just I'll note that the news media was duly notified and that a quorum is present, and we will move on to our first item on the agenda, or number 3, which is the report of our board financial consultant.
Thank you. Good morning, everyone.
Morning.
For you, we've got the large books that you're now more than familiar with. We won't go through all of the tabs in there. Those are kind of for your viewing pleasure. As usual, those are the quarterly fact sheets that give the updates on some of the managers that you have within your fund. If you open your books, you see this is the June 30, 2012 report. We closed the month at $41,628,613. Add in just below $40,000 of accrued income, got you to $41,668,015. Total drop balance for the period, $22,109,113. The month of June certainly was welcomed after coming off of a May. As we documented in the last meeting, May was a difficult month, primarily driven by the European markets. June had a nice little recovery for the plan, up 1.74%. For the quarter, that puts you down 92 basis points, which we feel very good with. There are some other plans that we see in peer groups that were down in excess of 2 to 3% for the year. Fast forward over to one more column, you see year to date, you're at 4.86 for the year, and annualized since inception return of 6.31%. June really kind of continued the theme that we've seen with the European markets and the jobless claims, but we have had some positive traction, obviously leading to a positive month of just under 2%, 1.75% to be exact. Some of the things that we're continuing to kind of see into the marketplace, while growth has been slow, and there's no doubt about it, it's been slow, it's been steady. We've had 11 positive quarters of GDP in a row. That's important when you think about things, because there's a big difference in making investments into an economy where you're a slow economy and getting weaker, or you are a slow economy and you're improving. And certainly the data of suggesting GDP that it's slow but improving. Not at the pace that everyone would like. I mean, certainly don't feel that it's been 11 positive quarters of GDP, but it has. Other things that we're seeing in the market, jobless claims got a little bit of a pop today, still at not historically worse numbers, but still kind of in the range of 8% plus for unemployment. But in the trailing 12 months from June back through May, they've added 50 million jobs. That's almost 1 million jobs a week being added to the economy. It's just highly competitive for those 1 million jobs. So there's still some work to be done to the jobless claims, but it certainly feels good. With the European situation, we're still kind of working and see how that affects may be, but one thing that I'd say that has been the effect thus far has been there's been obviously the fight to quality into the U.S. Treasury market, which has driven rates down lower. So given the options available to international investors, they are parking their money over here into the U.S. So long term, that should be good for some of the domestic prices going forward if anything does continue to unravel in Europe, which make no mistake, there is certainly a slowdown over there. Equity prices continue to be at low valuations, and just to kind of give you some color on what that means, so if you go to the peak of the tech boom of where we were, forward-looking PE ratios were about a 24 times earnings. Now we're in the 12 range, so about half of that number. So if you're looking at how cheap stocks are relatively to price to earnings, they still are valued very well. Now that doesn't mean they're going to go up, but you're certainly seeing money kind of carved into that on the institutional side, while we're still seeing record outflows into the bond funds, into the bond markets on the retail side, even though we're at all-time historically low rates. We hit 146 on the 10-year the other day. I think we were at 150, 151 this morning before we walked over. So that's certainly something to keep in mind, especially when you've got inflation at 2%. So you're talking about a negative 50 basis point real rate of return. So, locking into bonds at this juncture certainly doesn't make sense long time to preserve your purchasing power going forward for the future. The oil markets, we have seen that if you look for what's been the worst performer year to date, it's really been in the oil and services sector. Reason is the slowdown that you're seeing in Europe, the slowdown that you're seeing taking place in India, and the slowdown that you're seeing in China. Anytime you have a perceived slowdown on the consumption rate of oil, you're seeing a quick pullback into oil prices. They hit down just below $80 a barrel in the second quarter. We've now ratcheted back up. I think we hit 89 yesterday. If not, we certainly bumped right up against 89. So you have had about a 10%, getting close to that number run when we came off the 104 highs that we had in the first quarter. So we're keeping an eye on that. What's that mean for pump prices kind of going forward, having that little bit of an increase, and continue to monitor things such as like the Goldman Sachs Commodity Opportunities Fund. I was in New York 2 weeks ago and had an opportunity to sit down with their lead portfolio managers and kind of lay out where their direction is going forward. Those guys are certainly short-term bearish on oil, at least we're at that position. We've had a nice run, but long-term bullish, as I think everybody is. Interestingly enough, we hear a lot about all the oil-producing OPEC nations and kind of where they are. But probably a lot of people in this room may not know that the U.S. is actually number 3 in oil production. And in fact, for importing oil into the U.S., the number 1 importer to us is Canada. So they feel that the new measures of extracting petroleum or rough oil out of the ground is become obviously more expensive. And so that $70 number is kind of at the break-even point to a lot of these new extraction techniques out there. So it's really easy to get caught back up where $30 a barrel oil was kind of a historical average. Now getting into there, but if it goes below 70, it's just not worth pulling it out of the ground to some of these producers because just the price is so high for the new techniques. Food prices have continued to increase. They're long wheat, long corn, which has been a nice play. We continue to kind of see that trend as the world consumes more food. Also continue to look at world demographics and how the future 5-10 years and typically where you want to lay your investments out. What's that going to look like as you got to have an emerging population increase? Flipping forward a couple pages, we'll go to the pie chart, and then we'll talk about where we are in the portfolio changes that we've made since June 30, and kind of bring you up to speed on where we are in return. If you're looking at the pie chart, cash position 1.9%, that's right at 1 o'clock on the pie chart. Continuing to roll down, you see that we still have a tilt to growth over value. Again, by design, growth stocks are outperforming value stocks. That 6 o'clock on there, you kind of see your sector, which is your REITs, your real estate investment trust, your oil and gas, which is primarily driven with MLPs and master limited partnerships. Those are in there for, frankly, the yield they provide into the plan. Anytime we just went over the 1.5 on the 10-year, you're looking at 2.6% on a 30-year treasury. Anytime you have an opportunity to get a business that you understand and is yielding in the 6% range, we certainly like that inside of a spend rate plan. Going around the curve, you see your other at 20%. That is going to be your real estate, your mezzanine, and your Goldman. A couple updates on that. I gave you the Goldman. We don't have their June number yet. Preliminary is going to be down about 1% on the month of June, which puts them about even on the year. I met with another firm in New York, and they had a commodities fund, and something that we had actually looked at a couple years ago, and their update was down 18% for the year. So Goldman's certainly doing their jobs. When you look at that 20% fall off that we've had in the energy prices, and some of the other commodities, a lot of the guys have got caught up. Goldman stayed where they are and have stayed right now about flat on the year. Prudential and your real estate, another solid quarter, up 2.5%, 2.54% to be exact. Continue to see some improvement in the real estate markets, especially commercial, multifamily. You're seeing a lot more competitive bidding going into the situation there, meaning some of the guys who are going out and buying properties, just throwing a number out there and getting a bid hit, now have competition and you're starting to drop prices back up. That's because there is some value there. We're not really seeing the pickup in the home builders, obviously, because the supply that's still in the market exists. But for multifamily and for commercial real estate, still remaining steady. Saw a new forecast on default rates for the homeowners is still sitting around 9%. Mezzanine, they have had a recently good news in trying to unload one of their positions in Big Lake Oil Services. They had originally had an LOI signed, selling Big Lake for $32 million. The oil prices ticked back, a few other factors, and the person kind of said, okay, we're going to lower our bid from 32 to 30 million. They thought 32 was fair, so they decided to break that contract and reopen the bid process. They had 9 bidders, of which they invited 7 back into rounds, and feel like they may even push through that 32 million mark. So things are going in the right direction there, and I should have another update from them by the time the next meeting rolls around on where they are in that process.
And Bill, if that gets monetized, how much does that mean back to the fund with the original investment?
Somewhere between 70 and 80%.
Yeah, that's important. That's good.
So, yeah, certainly go in the direction we would like to go to. Where we are as of last night, we obviously had a really good week thus far, a couple of nice 100-point gains. We broke through 6%. We hit 6.02 as of last night's close. Before we walked into the meeting, we were up
Is that
30.
just for July or
Year to date.
6.0?
6.02 as of July 18th. Yeah. So certainly going in the right way from kind of the midpoint on the year. Obviously, we have a little concern. It's in a short memory of what happened last year, where you went into kind of a choppy May, a decent June, and then the bottom kind of fell out in the third quarter with the European situation. And really all the headwinds that we had in a difficult year, a lot of geopolitical risks out there. Still have the same geopolitical risks that exist. You still have the same problem with Europe and the fiscal policy over there. So we've been proactive and taken some money off the table in the form of some of the oil and gas services, and continue to look at where we are on the international spectrum. So we're taking about 5% off the table, and certainly feel that you've got some historically difficult months coming up with August and getting into September. So we're just being proactive in that regard, and like that position is kind of going forward. Hopefully we'll continue this trend of July of kind of an uptick.
Let me talk a little bit about specifics there. We took 3% off the energy side. We sold the Allerin MLP, which is our passive index. Sold out of that position. We took a very small sliver off of Maingate, which is also the MLP active play that we've had in place. They've worked out real well. We just think with the weakness in the energy, it was probably proper to do that. And then we took another 2% domestic equity, mid-cap value and small-cap value. So I think all in all, we left the growth mandate on the table. It worked out real well for us when we were up 100 points yesterday, because the value side underperformed and the energy actually was slightly down. So we made a good call on that. That raised roughly 5%. We took $1.4 million, which is roughly about 3.5% of that, and placed it in both low duration funds. So we kind of parked it on the sidelines. Short-term government agency. We all three have whiplash from what happened last year in August and September. So we just want to mandate that we lock in a little bit of this gain right now, be a little defensive through these next 2 months. Historically, these are not good months. We're hoping for the best at this point, but there's still a lot of negative influence on the market. Earnings-wise, obviously, are coming out. It's been great on the earnings side. It's been lousy on the revenue side. Companies are still reporting good earnings, but lousy revenue. And at some point, there's a conflict that's going to play out there. So that's a little troublesome to us. They're still trying to cut staff or not rehiring, but they can't find ways to produce positive revenue both domestically and globally. So that may catch up with the U.S. equity market, but we still like the equity market better than we do the bond market, especially on the long end. Just a little color on the real estate side. Prudential had a nice quarter, puts them up almost 8% year to date. If you combine that with our REIT exposure that we put into play, we've got roughly about a 13% play now in real estate. REITs are up 14% year to date. That's been a nice addition, but Prudential's done a great job. Their big portion of this quarter gain was in the storage sector. No surprise there. Storage units are still going leaps and bounds because people are having to store furniture and other property because they're either moving out of houses or they're temporarily in smaller housing or multi-housing. So that's worked out real well for them. I applaud Prudential. They've done a good job. It's a conservative play, but they've brought great returns. And, you know, if you annualize that, which I always am careful about doing that, you know, they could be double digit again this year. So it's a nice number. Nice number.
What's the, you call it low duration, is that listed on the pie chart as short-term fixed?
Yes, sir. It'd be PIMCO and BlackRock low duration. Nice thing about that is it gives us, if we need additional cash flow, we can go and pull that out. Or if we see a situation in the market that we feel a little bit better about, I don't like mentioning QE3, but if the Fed meets at the end of this month and 1st of August and Bernanke says we're gonna put in a QE3 play, then we might be a little bit more positive about the equity market in the short term so we can put it back in the market.
What's the duration on the short duration?
Oh, it's less than 2 years right now, I think.
Yeah, it's sitting at 1 and change.
1 and change. So it's real short term, but you know, those funds are up 3 and some change, I think, year to date.
Refresh my memory, but why does quantitative easing improve the stock market?
Well, I think from an emotional standpoint, it improves, not from a realistic or fundamental standpoint. It's like a shot of adrenaline more than anything else. I give it a short-term boost, and
Or
that's
an
it.
emotional,
It pumps a lot of liquidity in the market.
Yeah, depending on how much he decides to pump into the market.
and for the new board members, would you explain what quantitative easing QE is?
Sure, so
And all the different ways they can do it, Bo.
yeah.
Plus, it's not a fun topic.
The easiest way to describe it would be the Fed increasing its balance sheet and purchasing securities out to the marketplace with the hopes of driving down long-term rates and therefore stimulate lending and borrowing so that consumers go out and put money into the system.
Basically printing money.
That
But
essentially-
you drive down rates that are already this low. I mean,
Well-
what does that do?
Yeah, so obviously rates move on supply and demand, and so when you, let's say you put in, like they have in the past, $500 billion in purchasing longer dated treasuries, then there's the kind of the assumption that everyone says, well, treasury's going to be buying and rates are only going to get lower, so we're going to go in and buy them as well and continue to drive prices up, yields down on the longer end of the curve. How much lower can you go? That's a good question. You look at some of the other countries out there. Switzerland has a negative interest rate on their 5-year treasury right now. They just want their money safe. And so they'll take a negative rate of return to get their money safe. So you kind of keep that in mind, and 1.5% on the 10 years may look attractive if you're a large Swiss bank or a large Swiss insurance company versus parking your money there. So there are certainly some things. One thing to keep in mind with QE, and as this guy said, it is like a shot of adrenaline to pump into the system. Everything performs well because they know they're taking essentially measures to keep things kind of going as is. And last time, everything went up. Stocks went up, bonds went up in price, commodities went up. So it can kind of have a trickle down through really all asset classes.
But there is a downside.
Long term.
Cycling that money out, and they'll cross that bridge when they get there. Right now, if you look at excess reserves on the monetary base, it's just sitting there in banks. So it's not in motion. There's no velocity to all this extra money out there, so it's not being circulated to be reprinted around.
To give you, sorry, Larry.
Sorry,
Go
a
ahead.
couple points, and if you think about this, we're issuing debt on the short term, right? And we're buying debt on the long term. And so the additional demand's driving rates lower on the long end. What does that do? Well, it builds confidence that companies can go out and borrow money on the long end at lower cost. So as somebody just said here, it creates velocity in the money. If money can move, people get optimistic. But guys, there's a day of reckoning. We all in this room probably remember when Volcker was in office in '79 and '80, when Carter was in office, and we had interest rates in the double-digit, high-teen rates, right? So the Fed has said they're going to keep rates low through 2015, right? After that, they said they're going to let the market flow. What's interesting, there have been other countries that have done their version of quantitative easing, and they've really not been able to impact long-term rates very much more. So the market's not buying that the government actually has full control over long-term rates. So there's still some skepticism about issuing this kind of debt. as we all know on this end of the table, and probably on that end of the table, at some point, we have to pay this debt back. And if interest rates get out of hand, it's gonna be difficult. I had the opportunity to have dinner with the CEO of the Fed from St. Louis 2 weeks ago, and he, in his own words, said, we're running out of ammunition. You know, is there quantitative easing for? I mean, at what point does quantitative easing run out of its the good that it's able to produce? So that may be a lot more information than you want about quantitative easing, but that's what we're looking at and that's what we're thinking about.
Yeah, there are several Fed governors. To get any bang for their buck out of a QE3, it would be somewhere in the neighborhood of $1 trillion that they would have to do. I don't think.
Those are staggering numbers.
I just don't think that's even gonna come close to happening. They may verbalize and do an Operation Twist where they're buying on the long side and trying to drive rates down, but another $1 trillion? No, I don't see it. You know, an old accounting professor once told me it's hard to have a good income statement if you have a bad, almost said it.
You did.
Actually, that's what he said to me.
You're on record here.
Yeah, on record, if you have a lousy balance sheet. And our balance sheet continues to be lousy. I got there, I was right on it. Apologize for that, but that's pretty much how you sum it up. Okay.
I'd just like to make a couple of comments. So if you think about this, slow but improving domestic market with improving earnings, but as Alex said, at the expense of the top line. So there's not real growth, but there's decent earnings, but most companies are cut expenses. Record low rates. Why do we have record low rates? Because everybody's afraid in the foreign markets, and they're buying our treasuries at unprecedented levels, higher demand than supply, so it's driving rates lower. You have to think about how's Europe going to handle its problems, what's going to happen in their credit markets, what's going to happen in our election. I think we all have to be mindful of the unemployment rate, healthcare, and the turn back of the Bush tax credits. What's the impact of those? It does, our sense that in this end of the table is that by mid-October, we're going to have a much clearer picture of where the market's headed. If we could just settle down Europe and get things settled in D.C., and let these earnings start to build back, I think we can earn our way out of this. Alex has said a moment ago that Prudential real estate's doing well. It's true, between multifamily, storage units, and also if you have to think about this, people value real estate based on cap rates. Cap rates are driven by interest rates. Interest rates are low, it makes real estate look attractive, right? So when they give these kinds of numbers to Alex and returns, that is the way you generate and calculate those returns, but the real fact of the matter is they're the beneficiary of this low interest rate environment as well. So if interest rates come back up, guys, it gives us a whole new set of dynamics that we have to value from. But I think that, as Alex said, and what's the yield on the low duration, Alex?
Oh gosh, it's about, what, 160 right now, 165?
So are you getting a 165 yield on a 3-year maturity when government bonds on a 10-year are at 150? So we're taking 1/3 the interest rate risk and getting a current yield that exceeds the 10-year. That's the kind of value you're looking for in the structure. I think it's a pretty safe play, and you know we're happy with the numbers we're delivering to you today.
I want Alex to know it's all right to say shabby at this table.
I apologize. It's as close as I can get
That's
and
what
pull
you're
it
gonna say,
back.
wasn't it, Alex?
I'm still young enough to be able to pull it back. I thought it was gonna. All right.
I had a question for you.
Yes, sir.
You talked about August and September troublesome months, usually throw an election year on top of that. How historically has that affected an election year and those 2 months together?
Now, Larry, I think he's quoted this before, usually election years are decent years
They are.
for the equity market.
Decent years?
Decent, good years, positive years. But I don't know if we've ever had an election year with this many issues on the table. The fiscal cliff, the problems in Europe, the balance sheet dilemma that the Fed has. So I don't know, you can get caught up in historical perspectives too much and try to make decisions on those things. And we try to obviously do a little crystal ball reading, but you can get in trouble doing that too. But I think these are difficult times, and it pays to be a little bit, considering your plan, it pays off to be a little conservative here.
Both showed us a report the other day from JP Morgan that showed that the best market environments are when you have a Democratic president and a controlled Senate by the Republicans.
Yeah.
Is that true now? Who knows? It really, there's so many issues facing whoever's the president that, I'm not sure you can place a political party and say that controls where this market's headed.
If you look at our US companies and imagine being in an atmosphere where you really don't know the tax dilemma that they're gonna face on top of healthcare, which we already know they're gonna face, it's tough to ascertain promising earnings in the future. And it all comes down to that at the end of the day. We've really not had a quarter with really bad earnings numbers, probably now in a couple of years. First time we have that, how's the market gonna react on top of everything else that's out there?
Just
Uncertain.
Just to give you an idea, I mean, we're talking about corporations, but you as individuals, you're trying to figure out, what do we do with our money? Where do we go that's safe? How do we pay, if we're retired, where do we get a good interest rate? What are my options, right? If they change the tax law on dividends, then that changes your whole strategy on which securities you wanna hold. And we're telling you, we're not gonna know what that's gonna be until January. So imagine trying to sit there and figure out what you're gonna do with your money. Corporations are doing the same thing, so it's really important for DC to get some definition around what it is that they're going to do, so we can go make our decisions about how to best manage our process, both individually and corporately.
You know, tell me if I'm wrong, but, you know, we talk about corporations a lot. You hear that term thrown
Yes,
out
sir.
a lot in public. But corporations are people, and that's all the corporation is. It's owned by, it's managed by, within its entirety by people. Corporations are those of us sitting around the table and those members at home. They own corporations, and that's what corporations are. I mean, is that right, correct? or
Yes,
not?
sir. A corporation is nothing more than a vehicle that is, has certain tax structure. Just as you're an individual, you have a certain tax structure. But at the end of the day, it's about people and products and distribution and earnings and demand. And, lots of dynamics. It's fun on our side because there's always something changing. Y'all seen, we've been through a lot of good periods and bad periods. Fortunately, this has been a relatively good period. When I say relative, that means compared to everything else we're seeing in the marketplace, our accounts have done well.
Very quickly on the manager review, which is, I believe, tab 2, or right at the end of, right before tab 1, excuse me. This is our manager overview, and we won't go through all of these, but just kind of give you some flavor on this. The top portion, as you're well familiar, is the fixed income managers that we have. Just as a correction, PIMCO low duration yield is still at 2.5%, so I was a little bit low on that. But if you look at BlackRock, PIMCO, JP Morgan, the core group at the top, and then PIMCO real return and PIMCO total return, good returns year to date, far surpassing probably what we expected at this point in time from our standpoint. Again, this is a flight to quality, risk off trade for a big part of that. People still buying fixed income securities at a very low interest rate environment. At some point, when rates do go up, and it may be 2016, late 2015, then people will probably start rotating and institutions will start rotating out of that. But there's still flight to quality and to the safety factor. We've covered the other category of the three components, which make up approximately 19+% of the portfolio. And let's go down to the equity portion from large cap blend to small cap growth. Active managers have held up extremely well versus their index component. At this time this year, they're probably in the best position they've been in some time. Now, they were in kind of a similar situation last year, and then of course the market in 2 months dropped 9%. So it remains to be seen what's going to happen in the third quarter. But one thing I will point out to you, if you look at large cap growth there on the far left, which is JP Morgan large cap growth and the Russell 1000 growth, go over to your 1 year number. You're at 5 and some change on a 1 year number. Now look at the rest of the managers, both above and below, and throw out Federated Strategic Value because they're not a true value fund. They're a little bit of a hybrid. But if you look at the rest of the managers, they're all still in negative positions. Large cap growth has really kind of flamed out. Well, it's up 14 and some change after yesterday, and most of your other indexes are up 5-6%. So I'd love to turn the time clock back and up our exposure even more in large cap growth, but that's where the money's been made in the equity market. More so with companies that have domestic revenues than multinationals, because obviously the continental Europe and and even Southeast Asia has slowed. So from that standpoint, we covered the oil and gas and REIT sector at the bottom. We still like the oil and gas sector. By the way, it's up about $1.70 this morning, so we're up almost 2% on oil prices this morning. Some of that may be related to what's going on in the Middle East. And then our international managers, still, if you look at the one-year category, it's been brutal, but they're up 8% and 4%. Emerging markets lagging a little bit, and our Columbia Acorn International, which is a small cap international, has done quite well at 856. So what small exposure we have there, which is what 5 or less than 5%, we're going to stick with at this point in time. Okay. Any questions on the managers? Allocation, we're about 42% on equity right now. So we went from 47 to about 42. We could ramp that up, depending, and we're ready to do that. We're going to be active, and we're going to be a little tactical here. And if we're wrong, blame those two guys right there. No, you know that's not correct. Thank you all. Appreciate it.
Any questions for us?
Not on that. We do have, Larry and I had called, discussed with guys, 5B, no.
3B.
3B, concerning drop.
Yes, sir.
And as you all know, over the course of years, even going back before you all, there have been numerous discussions, board discussions in the past, both on the local level as well as the PRB level, concerning the ability of members to leave drop funds in drop. And there have been some reoccurring questions on that recently, and I think it's in everyone's best interest, I called you to address that, and if you would explain what the advantages versus disadvantages are that impact both ways, potentially to the fund.
Well, let's talk about it from a fund perspective first, and let's talk about it from an individual perspective, because I think you have to look at both. Frankly, we have looked at drop for a number of years, and it is market minus 2%, and we have dealt and interfaced with Jody Carrera for quite some time on this topic, both with members of this board and past members of this board. And Jody, I thought, did a pretty extensive review to determine what the impact was of drop on the plan. And he came back and said it was either neutral or slightly positive, right? Now, he gave that report in advance of the market decline that occurred in 2008. He has since come back and told us, and I think he's put it in writing here for you all, that even and he looked at over a long period of time. In spite of the recent market decline since 2008, he would essentially come back with the same answer if you rehired him to go integrate these recent numbers. So it does not harm the pension to have drop based on these historical performance. As a matter of fact, he says it's slightly positive. I don't know what slightly is, but it sounds like basis points. Okay. I will tell you that from a manager's perspective, Alex in particular looks at the liquidity that's required by us to maintain or to be able to meet any of the cash flow needs, demands, or withdrawals that may be taken from the account. So when we have a $500,000 or $1 million month, we have to look at the portfolio and decide where do we want to draw those funds from. And if you think about that, liquidity is number one. And number two, we always want to try to do it in the best manner that we can so that we don't impact performance. Well, we don't know when those individuals are going to make those requests. And if the market's down and we're in securities that have a loss, then that's really not a good position, right? So what I'm telling you is that we have to take into consideration those liquidity components when we're managing the portfolio. It's not hard, it's just a variable we have to take into consideration. So that's from a plan perspective, all right? From an individual perspective, where else can you go and be invested in an account that invests in stocks and bonds and have zero risk on the downside, right? Now, there are those in the marketplace that will market products that they say have similar characteristics, but typically there are risks or there are costs and expenses that are really hard to gauge. The only place that you can really go get guaranteed safety of principal are treasuries. We already know what treasuries are yielding because we've already had that conversation. The product du jour, the one that you hear most about, are annuities. Because they have a wrapper, an insurance wrapper around those investments. And the protection is the insurance company that says that we're not going to let you go below zero. That's for a variable fund. Right? And typically they give a percentage of whatever is earned in the portfolio that insurance company keeps. So they put wrappers, is what it's called, an insurance wrapper around it. So it buffers your upside and buffers your downside. Similar to what you're experiencing inside a drop, where you have no downside and you're buffered a little bit on the top side, but not totally because you're getting the market -2. If you don't go that route on an annuity, that's a variable annuity, then you can go to a fixed rate annuity. And fixed rate annuities, in my opinion, are a nice way to get a good current yield with some stability. It's generally tied to a life expectancy. The challenge with that is it sounds appealing to the layperson to get a good current yield in today's interest rate environment of 3 or 4 or maybe even 5%. But what happens if interest rates go back to where they were in the 70s, like we talked about a moment ago, and you've locked in for your lifetime, the remainder of your life, a fixed rate of 3, 4, or 5%, and interest rates go 7, 8, 10, or 12. Right? So I think there's inherent risk of taking that money and moving it to an annuity. It is very popular for guys in our business to market those kinds of products because traditionally those are nice commission-driven products, i.e. they pay 4, 6, or 8%. If you can't figure out what you're paying because these products are complex, here's what you do. Tell them what your number is you're going to give them. Tell them you'd like to have your money back in 1 year if I decide I want to get out. And look at the difference between what you put in and what you got out, and you're going to know how much you paid for that experience. So, Ferris, maybe a little more than you asked for, right? We think that it's important to look at it from a macro perspective, from a plan perspective. It's also important to look at it from an individual perspective. We cannot sit on this side of the table and make a recommendation for every person in this room or all the people that are in the pension plan to tell them what's best for them. But it's really important for them to have an opportunity to understand the dynamics of the product that they're investing in and not just purely hear it from a sales representative.
Larry, this, and no, it's not more information than I would like. In fact, maybe not enough, because I'll tell you, there is a lot of misinformation out there among the members, and that is the most dangerous thing in terms of this fund, in terms of the individual member's financial risk. Now, one of the misnomers, if you will, is that there's nowhere else that members can go. They're going to leave their money in drop, and there's nowhere else that they can take their money and have the guarantee of not losing principal, i.e. Zero floor. Well, a misnomer about that you just briefly covered, and that are salesmen, financial salesmen, that goes out here and aggressively approaches. They get lists by drop members, they aggressively approach them, and they do a sales pitch on them. And you just outlined some of that sales pitch. We will guarantee you not a zero floor, but a 5% return if you will buy our annuity. And like you said, it sounds very appealing on the front end. So, you know, when statements are made to the effect that there's nowhere that members can go and get these guarantees, that's simply untrue. In fact, they can go out here and they can get far better than a zero floor guarantee. But they are going to assume risk, and they're going to have they can be assuming risk, they're going to have downside, and they're going to be selling their money basically in the form of annuity, if I understand it correctly.
Yes, sir. I just, listen, the realities of the world is, nobody on our side of the table will guarantee you 5%. I don't know where those folks can take their money. Insurance companies or otherwise can go invest their money and guarantee 5%. And so it is a rate that is an attractive rate. It's better than the market offers. It is an incentive for people to consider placing their money. And, you know, I don't want to yield my time, but I'd just like to say, Roger has experience in annuities and has done a lot of this in this space. So we're not, you're getting one opinion from us, all right? But we've done this for a long time. I've served as an expert witness on annuity contracts, so I have a good working knowledge of how they operate. But to say that we can make a blanket statement that applies to all individuals would not be accurate.
Well, and you know, the thing of it is, and we really, for the benefit of members and the benefit of this fund, we need, in my opinion at least, to spend some time looking at this and talking about this. And one thing that we hadn't covered to any degree is, we kind of talked about, you know, the availability of other investment vehicles for our members who have drop accounts, who are moving in, and quite frankly, we need to get this information out there. Members are pulling it out of drop, around $1 million in the last 4 or 6 weeks or so. And that always occurs when we are in flat markets, because members get drop statements. They've got salesmen, financial salesmen out here trying to sell them financial vehicles. And it sounds attractive, so they do that. But one thing we hadn't covered, we need to, is what is the impact? What is the financial impact of this fund when large numbers of members, large amounts of money is moved out of drop? Maybe you would want to address, and there's some people saying, why do we even allow members to keep their money in drop? Well, that's over $22 million. What would happen if, say, in the next 6 months, you knew that all $24 million was going to leave this fund?
Well,
what impact would that have?
Alex has a real opportunity to look at this regularly, and I'll just tell you that in the event that we had knowledge that that was coming, it would dramatically change the way that your current mix looks in the portfolio, because you're a smaller plan, you're an aging plan, and it takes some of the opportunity we have to provide for growth. We probably have to move to a more liquid environment, and so I think it might impact long-term the returns of the portfolio. Would you agree with that, Alex?
Yeah, you know, we're maintaining right now about 17 million of the 22 million in drop, 22.1, I guess. And to be up 6% year to date when we've got approximately 20% in short-term cash component, the low duration funds, you know, we're pleased with. But if you continue at a rate of pulling out drop, it would change the complexion of the account, because you got to remember, you've got about 19% in what we call locked up vehicles. The Goldman's an exception because we can't get that money out on a quarterly basis. So, you know, that becomes a larger allocation if you pull out drop and you have cash go out and you raise more cash flow. We're not having any problems right now raising cash, but I'd say if the velocity of the drop increased, yeah, it would present some problems for the allocation.
And give you an example, when you have a mezzanine finance investment, right? I mean, that was a prudent investment, a reasonable allocation, and a size plan that we were managing at the time, right? You heard me ask Bo a moment ago, what percentage does that mean we're gonna get our money back? Because we know liquidity is important to this plan. And we recognize that we need to get a payday back from those guys for a lot of reasons. But if you took all the money out of drop today, and withdrew it from the plan, imagine what that asset becomes as a percentage of the overall account. It's not a good allocation. It's not an allocation we would have recommended on the outset. So we're sensitive to this cash flow needs. We think it does. We think it could have a bearing. I think Jody did a good job of saying, you know, over the last many years, this didn't hurt us. Matter of fact, it may help us a little bit. But going forward, y'all, you know, in today's interest rate environment, people are looking for yield, and I understand why they are, right? And if somebody would offer us 5% guaranteed, and I can get my money back later, I'd be inclined to take it. But I know that it's not a realistic number based on what we see happening in today's interest rate environment.
So get back to Ferris's question,
Yes,
if
sir.
22 million was withdrawn, I understand you said that would harm the fund right now, the way we operate.
It would,
I wouldn't say the word harm
Yeah.
is a correct terminology, but it would change the complexion of the account and how we allocate.
And it might impact the ability for us to earn the kinds of returns we provided today for you going forward.
So you're saying that we wouldn't average the returns that we're averaging?
You know, I mean, Lee, it's hard for me to look into the crystal ball and look forward. I just know it's gonna change our composition, as Alex outlined, and that composition is probably gonna have a bearing on long-term returns, because we won't have the latitude to make some of the investments that we've been able to offer to you in the past.
So we lower interest rates than we've had.
I mean, we have, you know, I have to look at your real estate position, we have to look at your mezzanine financing position. The rest of the positions are all very liquid. We have to become slightly more income oriented on the remaining assets, and so it does have a bearing. For me to sit here and tell you I know exactly how that would quantify, what that would mean from an economic perspective is difficult, but it certainly, it'd be a very different environment than what we're faced with
But I'm
today.
getting back at, we would not, I understand you saying that we would not earn the returns that we earned in the past if that happened, the drop money that disappeared.
That you would not earn?
That
Our returns.
been returning.
I don't know that,
It's hard to say.
I don't know that I could answer that.
Okay.
Let me say a couple things. This may stimulate one more aspect of it, and then we can move on. But, what members do with their money is entirely up to them, and decisions are influenced by a multitude of different factors. That's the way it is, it's the way it should be, I think. But, and drop within itself is, let me use the analogy, it's a two-edged sword. It's both good and bad for the fund. Two examples of the extremes, and correct me if I'm wrong here. One example is when we have severe downturns in the markets like '08, drop costs the fund money.
Yes, sir. That's
Okay?
correct.
Now, after those downturns, when we have upside, which has been since '08, okay, 4 years now, if the year after that downturn, all the members pull the money out of drop, we don't capture any of the upside, which, using round figures, has been about $500,000 a year that this fund has made since '08. A couple of $1 million, that's just rough numbers. So, is that an element of, and although it may or may not directly impact to a large extent the annual return of the fund, does it not affect the bottom line after these downturns occur?
You know, Ferris, what Jody did is he took and said, they're good and bad markets, over the long term, it was slightly positive. If people had the latitude to pull their money out during the down markets and come back in during the good markets, it would clearly have an effect. Right? What you're suggesting here is that if the market went down, everybody pulls money out, yeah, it had an effect, right? But just like, the long-term rates of return that you've experienced were 631 for the last 20-plus years, is that right? From '86 to 2011, right? So, you know, those markets up and down have an effect. If you took your money out on that day, it would have a bearing. But when you blend it out over the long term, incremental withdrawals, prudent withdrawals, based on people's own individual needs, has not had any real bearing on this. If they all decided to take it out tomorrow, it would have a material effect on the portfolio. It'd have a material effect on us, how we're gonna manage it, and frankly, it would change the composition of how we manage this account going forward. You are an unfunded plan. For investors to be able to have a benefit of a zero floor and a 2 minus the market, it is an investment that we think is a good investment. We like that strategy because we take that bet every day, and we don't have a zero floor. Is that helpful?
Yeah, yes, it is helpful, and Madam Chairman, I would just ask one thing, although, you know, this may not be exactly the way we always handle things, but if we have a couple of members here, and since this topic has just been discussed, I would hope that it would be appropriate, please, the board to entertain any questions they have regarding this issue.
My colleagues here make a really good point. I didn't think about this. If you take the money out, if you took all the drop out, and still looked at the pension benefits that are required, What are the numbers again, guys?
7 million a
About
year.
7 million a year.
Spend
Is that
rate.
correct?
So if you took 7 million of your spend rate on the portfolio of 9 million.
19.
19
You
million,
really
right.
placed the portfolio in a position where we're gonna have to manage it almost purely for fixed income. And Lee, to answer your question, the returns would not be as good as what you experienced.
It'd be impossible then. You got that much spend rate, that's a 37% spend rate.
So it would force the portfolio, the portfolio into basically a fixed situation.
Yes, sir, in an environment where it's not.
That's the worst thing you could possibly do.
Declining back.
Yes. So the plan is the beneficiary of the drop assets. And we think the participants that have drop are the beneficiaries of the plan assets. They're stronger together than they are apart. If they depart, then it changes, I think both of them pay a price.
Chairman,
Is that the same thing, Ron?
So we've had a request, and Don indicated he wanted to speak as well. So you want to move the fund member comments up on the agenda? Is that what the request is?
That'd be, there's only two here.
Okay. And I don't know who wants to speak first.
Yes, my question is that, from the way that the information has been laid out today, I have a tremendous amount of confidence in your organization in whatever funds we lay at the doorstep for you guys to manage. My concern is that this pension plan was started with a process in mind that you put into the pension for the 20 years. Then you have the ability to draw half of, your pension, your monthly salary out as a benefit to the individual police officers. At a point in time, the drop plan was put in place. It's an extra layer on top of the pension plan. There are a lot of members, myself included, who are not drop members. And I am excited that they have a zero floor. I am excited that they have a personal benefit. I am concerned about the risk to the non-drop members who are the actual starters of this pension plan. And so when we make decisions, there is a strong individual portion of thought that needs to go into this, because we have heard pension members talk in the past about that they retired as assistant chief and made $350 in the pension plan. We brought them up, to $1,000 plus. Those are all great. But the thing about it is my family stayed with me and suffered through the time that I went through the police department to the benefit of the city. And I was promised, guaranteed, it was part of the sales to bring me into law enforcement, that half pay retirement would be there as long as I lived, and if I was deceased, that my wife would receive the benefits until she was deceased. So that is something that it seems like we pave over, and we have constant conversation about the drop plan. But gentlemen, and ladies and gentlemen of the entire board, the drop plan is not the pension. The drop plan is something that attached itself to a vehicle that I'm concerned, can the vehicle continue to carry the drop plan? So when we have these conversations, I feel like, from not you guys, but I feel from a portion of the board, that I'm being sold on the drop plan. The bottom line is I'm not connected to the drop plan by choice. The drop plan was laid on my pension plan that was never discussed whenever when I went through my career. So that is something that I really want the entire board to keep in mind, is that there is a pension plan that is the vehicle that allows the drop to exist. And I do have total confidence in y'all's ability, understanding that the proportions would be changed and the ratios and the style of investing would change if the drop plan disappeared. But there is a pension plan that has to stay healthy for myself and other members like me that are not dropped, and the family that allowed us to be the policemen that we were.
Yeah, just a couple of things.
Well, should we
go
not
ahead.
allow the
Yes,
other members and then have board,
because it's
okay,
our-
yeah,
our
so
turn
let's,
now.
Sure.
Don, you're recognized.
Okay.
Were you finished? I'm
I
sorry.
Yes,
have
ma'am.
no- I mean, I respect y'all, and I think, I don't know how Mr. Stevens was good with hands-on managing money, but I think he surrounded himself with some of the most intelligent, professional people that's probably in the state of Arkansas or in the United States.
Thank you.
I appreciate
You should tell my
y'all.
boss that, would you?
I appreciate y'all, and I appreciate y'all's dedication.
Thank you, sir.
And I feel like if it wasn't for y'all, our fund would probably be worse off than what it is. And I hope this board and the future board stays with y'all on this. And after saying all that, I'm really not real fond of the stock market. I'd rather do stuff that I have punch the buttons and turn the knobs myself, and not worry about what some joker in Italy or Spain is doing.
Yes, sir.
And kind of going along with him, I agree with y'all. I agree with all of the drop members that's on this board, which I think that's all of you, isn't it? And all of y'all drop members? I just asked a
I am.
question. Are you?
No.
Are you? Are you? You?
Yes.
Okay. I think it's the grandest thing in the world for them because they have no risk whatsoever, just like what y'all said. Us 225 are carrying the risk for these people. And some people have asked me, and now, I don't know, they just asked me, why was this even started in the first place? Because, our state actuary guy says that, it maybe slightly helps us. Well, I don't think slightly helps us is worth the risk that the rest of us are carrying. And I don't think, I think it would change how y'all have to invest the money if drop pulled out. But I think y'all are intelligent enough that you would probably come up with about the same amount of money as we're getting now, which really is not that much. And I'm through talking. And I think there's a state law that was passed in 2001, Act 1244 of 2001, House Bill 2254, and I'll give y'all a copy of it, that the drop members on this board are not even supposed to discuss anything or try to influence, in which, everything that I've heard from the drop members has been, oh, we gotta keep it, we gotta do this, the best thing in the world, which it is for the drop members. But I would like for the board to consider this and have the attorney, the fund's attorney make an opinion on it, because this law says, and I'd like to keep one of them, this law says that it is strictly a conflict of interest for these drop members on this board to discuss or try to influence or have any vote on anything to do with drop.
Thank you. We'll ask the board's attorney to review that.
And I would like to say further that I would appreciate no more discussion from the drop members about drop until this is resolved.
I want to make one other
Now, y'all can
point.
tell me to leave or go do whatever you want to, but that's my opinion, and I, so, that's my opinion, and I think the law backs me up on it.
Thank you, Don.
And I think, there's been 2 or 3 people with quite some extensive knowledge on this that agrees with me.
Tom, where does it mention dropping here?
Do what?
Where does it mention dropping?
Oh, I don't mention drop.
Oh, okay.
Oh, I don't mention drop. Right here, what it says here,
Excuse me.
is no member of a state board or commission or a board member of any intent of receiving state funds to participate in, vote, or influence or attempt to influence any official decision if the member has a peculiar interest in the matter under consideration by the board.
Okay, well, we'll have our attorney review that, and so, Larry, I
I
think
just
he
have
has to
one
be
more
recognized.
economic point, that's not really intended to take a position. All right, first of all, I'll tell you, Stevens is a money manager, not a drop advisor, all right? And really, that should be, you should rely on your actuary to tell you the benefit or weaknesses or the impact of drop on the plan. So we're giving you an opinion, as your investment advisor on what it does from the portfolio perspective. Okay, that's number one. Number two, one of the things I think Jody has to take into consideration that I don't know that anybody's thought about, and I was sitting there thinking about it, the bigger the percentage of drop as a percentage of the portfolio, the greater the impact that a down market can have on the portfolio or on the pension plan,
Oh,
right?
and to some points, and like I said, this is no reflection on y'all.
No, we're not, this is not personal.
And some points I agree with y'all, and I am afraid, really and truly, I'm afraid that this drop thing is done, created into such a monster that it's probably gonna ruin the whole thing.
So I would ask.
Because if we had a.
But Don, I mean, Larry has the floor and your comments, you said you were finished, so if you can let
Okay,
Larry,
yeah,
I'm sorry.
okay.
I just.
But no, you can, please
Thank
stay,
you. Thank
please
you
stay
very
and
much.
listen.
Thank y'all for your consideration, and thank you, ma'am. Anyway, I would appreciate if none of the drop people would talk anything about the drop until this is resolved. I plan on it.
If I may address that.
Well, excuse me, but Larry, were you
No,
finished with
no,
your?
I just want to make one suggestion,
Okay.
all right? Is that if you ask Jody, who I think is your authority on this matter, that one of the things he needs to take into consideration is what is the impact based on the percentage of the portfolio that is carved out for drop. Because it's our opinion that the greater the percentage of drop is of the total account, the greater the impact in various market conditions. And that it's his probability of whether it's a credit or a debit to the account is really gonna be influenced by that percentage.
The benefit.
Yes, sir.
Mr. Chairman, could I
Really get
withdraw
more money
that
involved.
I finished, and could I say one thing?
Yeah.
Okay. But it also, the bigger the drop, the more risk it puts on the other fund.
Yes, sir.
Okay.
Yeah, I think that's what Larry said. Okay. Ferris, did you ask to be recognized?
Yes, please. I'm assuming we're going to have a shake.
Yes, we are.
Just looking over it, I think the point being made was simply this, that drop members have an interest in drop, therefore it would be a conflict for them to vote on the issue that involves drop. If that is indeed true, I don't see how any of the board can vote on anything regardless, simply because, for example, if there's many benefit increase, that affects in a positive nature every member of the fund to an argument can be made the detriment of the fund. So therefore, none of the police members on the board would ever be able to vote on such thing. Now, to address just, but I do welcome an opinion on this so that we can get that particular issue resolved. Another thing, as far as talking about drop, the reason we talk about drop is because drop is a member of the fund and because members bring it up and we have to respond to questions about drop, just like we have to respond to questions about everything. So, we're all members of this fund, and hopefully we will all be able to draw our monthly benefit check as long as we live. So there's no member that is any less or more vested with an interest in the stability of maintaining a monthly paycheck than any other member. That's the only distinction I want to make.
And thank you very much. Are we ready to move on now to approval of the June minutes?
Yes.
Were you excused?
Yes, you are excused. Thank you for your attention.
We'll keep you updated.
Adios.
See you, George.
Bye.
They were distributed in advance of the meeting. I'll entertain a motion to approve the minutes.
Second.
Okay. Moved and properly seconded. All in favor? Opposed? Okay, minutes are approved. We'll move to the report from our attorneys. Pam?
I'm still doing some research on the, Adina, I keep saying that one, is it Adine?
Adine.
Adine Garrett. There's two components to it, there's a criminal and a civil, and I still need to do a little more research, to be able to give you guys a final list of what your recourses would be on it. So if it's okay with you guys, we'll go ahead and table that. I guess before you can agree to table that, I don't know if you all know that I'm expecting. So I'm due next month. I'll be delivering next month, so probably it won't be next month, it probably won't September. I mean, it won't be August. I'll possibly, depending on how the dates fall, I'll be back in September. There will be another attorney that's filling in for me. Beth Carpenter is my backup. But on this issue, I mean, it probably be best if I could stick with it and maybe let you guys know September, October, a final report on that. That's okay. And then Kathy has not been able on 5B, a resolution for surviving spouse benefits. Kathy has not been able to locate a resolution on that, but you guys remember having passed that in the past, which basically, generally, your recollection is on target. It's just a matter of us finding the paperwork to go with it. So, I don't know, Kathy, do you want to keep looking for that resolution?
Can we not check with the PRB too? I mean, y'all's thoughts were that it was part of a benefit increase. It seems like as we've made changes to the plan, the PRB has a record of that as well. I don't know if they would be able to produce that or not, but I would suggest maybe following up with the PRB.
Should we table that to next time?
Anything else?
That's all for me.
And we've asked you to review the bill that was brought to us today, so if you'll add that to your list. Thank you. Roger, welcome back. You're
Yes,
up.
ma'am. Thank you. Apologize for not being able to be here for the last couple of months. I'll try to go through this. There's 3 or 4 different subjects, I think, that I may want to at least make you aware of. First of all, obviously you're aware of changes in the funding formula that generated more money for the old plant here in Little Rock. Both police and fire benefited from that. And you were probably, as a community, the largest benefactor in the state as far as the amount of change in terms of dollars that it meant to you. So very, very important. There has been some pushback. Ferris, uniquely, since he serves on the PRB board, has heard some cities that have come to the PRB board to complain a little bit.
I've heard it too.
Well, I'm sorry. I always kind of assumed you weren't paying attention. I'll pay for that.
I've heard that somewhere.
And there may be some reasons that they're unhappy, but they're really not justified. The ultimate change in the distribution of premium taxes was to address a specific percentage, the same for every single city, on the base benefit. It doesn't take into account COLAs, it doesn't take into account ad hoc increases, but the base benefit of 50% of salary, which is guaranteed. I mean, as such, if this fund runs short, then obviously the city's got to make up that difference. But the point being, on the redistribution or the distribution of those premium taxes, everybody's being treated alike. And I'm going to single out one example of a city that's complained, and that would be Russellville. Russellville's benefits are 100% of salary, not 50%, plus they get an additional $500 a month. Their funding was reduced because, in essence, we had been subsidizing their benefit increases for years and years and years. Naturally, if we take money away from them, they say, wait, what happened? And now they're complaining a little bit. They don't really have a foundation or a basis to complain.
because they're still being funded the same as everybody on their base benefit, but naturally they don't like it. So, just to make you aware of that, I think it could be a potential legislative issue that some folks may want to try to change the funding formula once again. The current funding formula is as good as it has ever been, for everybody included, including Lopfe, by the way. So, I don't know how you can get any fairer, but there's always somebody that wants to change things so that it's fairer for them as opposed to everybody else. So just keep that in mind. The Municipal League had their annual meeting here not too long ago. Was it in June or possibly?
I think it was June.
One of the resolutions that came out of that is kind of interesting. I don't have a copy with me, but I do have a copy of it. And it basically says they want more money to subsidize old plans that are underfunded. Sounds like a great idea. But the way they want to come up with that new money is to take it away from the distributions to Lopfe. Let's reduce what we have to pay for Lopfe, and additionally to close Lopfe and create a new tier for new hires at lower benefits.
I like state police.
Thank you. Exactly. And anytime you close a plan, you cause expenses to rise. Now, this proposal or resolution isn't very well thought through because, let me make this point, and I think that all of you here understand this very, very well. The PRB makes recommendations to the city members as to what they ought to pay, but they don't have to pay. They choose to pay whatever they choose to pay, right?
On what, Roger?
On their cost for benefits.
The contribution to the local plans.
You as a PRB board member, you recommend a number every year that goes out to those cities as to what they ought to be putting in to cover their costs. But they're not mandated to pay that.
Well, they don't.
Strictly voluntary, and many don't. But on the Lopfe side, that's not an option, it's statutory. Whatever the Lopfe board sends out, that is their contribution rate. So if you reduce the premium tax funding for Lopfe, what happens? You're gonna tell them to put in more money.
Right, right.
So the effect of this resolution would be that employers' costs would go up, not down.
Well, the
And
other
there's
thing
more
is,
members in Lopfe, so it would go up more.
with the change in the GASB reporting rules for pensions as well, the cities are now going to have to recognize their share of the unfunded liability of Lopfe on their balance sheets as well. So in the past, when the thought was, once everybody merged with Lopfe, that's great for the city, there's no liability anymore, no unfunded liability. That's not true. There is an unfunded liability.
And I appreciate you making that point. It's a very, very critical point. And it is going to affect potential legislation. But on this little resolution, it's really not good for employers. It isn't good for employees. It hurts the Lopfe plant. It hurts the employer's cost basis. All the way around, there's no winner in that. And what do they want? They simply want more subsidies for their underfunded plans, which in many cases...
Who's underfunded plans? I mean, which, because Lopfe has an unfunded piece as well.
No,
So-
I've talked, well, the unfunded piece is kind of stands alone. Those are the
Right.
merged plans.
Right.
As far as the corpus of the monies that are managed under Lopfe's management, there's the old plan piece is kind of handled separately. But my point is that this resolution would have negative effects. It would have a negative impact. Now, I'm going to come back to this in a minute, but I want to bring up the election cycle that we're in. Some people are paying attention, some really aren't. The balance in the Arkansas legislature in terms of who's in the majority may change, and it may not change. But the conservative side of the House and the Senate are doing their level best to gain enough members to have the majority. And if they are successful in the House, then they will put their own speaker in, and they will then have the power of appointment to the Joint Retirement Committee for its membership. That is entirely controlled by the Speaker of the House, as well as the chair of that joint committee. And on the Senate end, if the majority changes, they have different rules, but the majority will have the ability to load that committee with whomever they want to. And it is not a popular committee. It is, there's a lot of work involved in the Joint Retirement Committee, and it's hard to understand the issues. So guess what? Most people want to be on high-profile committees like Revenue and Tax or Education. They don't want to be on retirement. So the guy with the least amount of seniority ends up on retirement. And who would that be? A newly elected person that has no experience will very likely be a committee member to the Joint Retirement Committee. And they come in with zero understanding of how any of the pensions work. So for me, that's not good news. It means a much greater hill to climb in terms of educating those people and helping them to understand the picture of how this stuff actually works, why it works that way, and how we got there. So am I concerned? Yeah, I'm a little concerned. So I'm paying attention. I think we're going to see a change in who the chair of those committees is. And that's problematic because we have a good chair, but he'll have a chance to move up to a different committee this time and will probably choose to do that. So I'm just giving you a little bit of an idea of the dynamics of the legislature and what will be happening this fall. And we won't know much of anything until after the election, and we still won't know a lot until January. So that's just the way it is. I will tell you this, that the leadership in the Senate, should they gain a majority, will rest in the hands of Michael Lamoureux. Senator Lamoureux is from Russellville, just so you know. You can connect the dots.
That's so easily explained, though.
Back to what you were saying, Roger, on the municipal league, where they wanna close Laffey, open up another tier.
Yeah.
Tier system, pay less, and mandate that, this fund be funded, is that what you said?
No, they just want more money.
I mean, mandate more money.
Yeah, they want to get a bigger piece of the pie,
For
a bigger
this-
piece of the premium tax.
For these funds,
Maybe not you,
I mean, but for the old funds,
yes.
and it'd be mandated, is that what you're saying?
Well, they're just wanting to make a change so that they're entitled to more of that money. They're not wanting new money, they just want to take somebody else's money, which, you just think about this, shifting the money from lot fee to PRV doesn't accomplish anything. And in essence, the one thing it does accomplish is a higher contribution rate for all the cities involved. It won't do what they think it will do. So just the point I would make is, they didn't think it through very well, and whoever came up with it has no idea how any of this works anyway, which is pretty much normal. Now, will it pass? I don't think so. I think that the cities will have a revelation at some point when it becomes clear that their costs would go up. They will suddenly decide not to push that issue much further. But I'm just telling you what's out there, so you know. It's there.
Do you know who brought that to the municipal league?
I don't, and I'm sorry. But I think it was a mayor of probably not a large community.
Would be Pine Bluff.
I think it very well could have been Pine Bluff.
Okay.
I just don't know, and I'm sorry.
Did you have anything else?
Yeah, I do, and I want to go back now to this conversation about the distribution of money, premium taxes, et cetera. The city of Hot Springs hired an actuary from the state of Florida, or at least he lives in Fort Myers, Florida. And he's with a firm that have offices, I guess, in Louisiana and other places. And they asked him to do an evaluation of their plan, their old plan, is what they're looking at. And he gave a report about a week ago Monday to the city board there. And their debt for their old plan is somewhere north of $40 million, closer to $50 million. And what he focused on in his report was that there was an anomaly of $1 million that really couldn't be accounted for. He never did really talk about the $50 million or $40 million that they owe. There was absolutely no conversation about what to do about funding their liability that they have for their people. None. And instead, his whole approach was to criticize lot fee and how they account for things. And some of their complaints, by the way, will be dealt with the new Gadsby rules, because you are going to have very specific numbers that you haven't necessarily had in the past. But it was really interesting, and the rest of his, when he closed his presentation, he was even suggesting to the board that they look at getting legislation to allow them to just get out. Now think about Hot Springs, just for a minute. That's where this occurred.
if they were able to withdraw from lot fee, by the way, their old plan is merged. If they were able to withdraw, what would they get back? They'd get back probably the amount of money they originally came in with, which was $500,000. And then they would have to manage that money as a highly volatile closed plan on their own to pay out benefits forever. In other words, it wouldn't be less costly to them, it would be more costly, right? Isn't that logical? It would cost them a great deal more as a city to fund that plan. And he even encouraged them to call other cities, and maybe they could all band together and have a piece of legislation to allow them to get out. The moment you allow plans to back out of this pool, then you cause the cost to rise for everybody else. Our pension plans are a little bit like insurance, if you think about it. If you had to self-insure your house, your car, your health insurance, what would your premiums be? And if you lost a house, could you afford to just write a check to replace it, or the car? You buy insurance to pool your money in a pool of others so that your cost is less and the risk is borne by the entire pool. That's the same way pensions work. So the fewer people that participate, the higher the cost. And I'm not sure what this guy's agenda was, but he wasn't truthful. He did not have any knowledge of premium taxes. He had no idea that that subsidizes the city's costs. He had no knowledge of the benefit structure, how it works. He said they had absolutely no say in setting their benefits in their old plan. Who sets the benefits in the old plan? You do. The board does. So I thought his presentation was very misleading, and sure enough, he accomplished what he intended to, and that was stir the board up and got their focus off what they owe, and their focus was on $1 million, that there was an accounting anomaly. And by the way, that anomaly, the money was placed where it needed to go. It just, he wasn't able to track it that way. So I'm telling you all of this just to let you know that the information that gets out there can mislead people to a great deal. And that never produces positive results. And I'm not trying to back up to your previous agenda item, but annuities as an example, when somebody tells you they're selling them and they guarantee you a rate of interest, nobody guarantees you anything without penalties attached should you take your money out. Every annuity ever sold, other than an immediate annuity, where you start receiving payments every month, any deferred annuity has early withdrawal penalties. Anybody ever had a CD in the bank? Was there an early withdrawal penalty? Of course there was. The bank wouldn't let you just put it in one day and take it out the next. So when you net out the result of those penalties, it isn't nearly as rewarding as it might appear. The reason that we set the drop up legislatively, allowing plans for people to leave their money in drop, was to provide relief for the members so they didn't have to immediately take that money and go make a decision about what to do with it. We gave them time. And the benefit to the plan was the plan had the ability to continue to manage that money for a long, long time, and didn't have to pay it out at that point. There's certainly no risk to the people really with their money in drop, but the plan benefited as well. And maybe it was too generous because there weren't any penalties for taking your money out, but you can't put it back in if you do withdraw. It probably has been a benefit to this plan to have that money invested for the last however many years you've had it there. It's helped your returns. It's given you probably more money than you would otherwise have. Does it threaten the base benefit of all of your members? And the answer to that is I don't think so, because those benefits are guaranteed. And they're guaranteed in essence, ultimately, by the employer. So I know it's a dilemma, but I bring it up just to say this, that people like a good story. I mean, the better the sales pitch, the more likely the salesman is to make the sale. And people selling annuities are trying to get that money out because they're going to make somewhere around 3% or more on whatever gets transferred. So if somebody pulls out $100,000, they make 3% of that. And and of course the member's not necessarily greedy, but they think they want to get as good a return as they can. Eventually all this money has to go out and generate income for the individual at some point in time, and they would typically annuitize it. But
I think this legislative session is going to be, I said last year it was about defense, and yet we got some things accomplished. I think this year it's gonna be even more so about protecting what we already have, and not letting somebody do damage to us. Because some of these ideas will truly hurt the employer, and not help the employee at all. So, it's just the way it is. And by the way, this thing, I'm not an attorney. The purpose of this legislation, I was there at the time, this had nothing to do with pension plans. This was about state boards and commissions, like the Game and Fish Commission and those kinds of things.
I wouldn't think it could, because then you'd never have a pension board, because they're all for their pension, I mean, the members
I mean,
benefit from
you
the
have,
pension funds,
you
so
have people
couldn't
that
have a
serve on
pension
the
board.
teacher retirement board,
Yeah.
the APRS board, et cetera. And this was not about pension boards. I think the confusion is when it says state money. But
Well-
your attorney will help you determine
I'll find
whether that's
that out.
problematic. And that's all I have, unless there are questions.
Can I just say one thing in
Yes, sir.
regard to our good friends from Russellville? What you said was well taken. I mean, you know, obviously, we're all on the same playing field. You know, as it turned out, we didn't know we were going to, Little Rock got a windfall from that legislation. But to the detriment, not to the detriment, but I can empathize and sympathize with those folks like from Russellville and some others who was accustomed to getting $800,000 a year for their fund, and now they're getting nothing.
But, you
That's
know,
all.
Fair, so I would argue that Little Rock did not get a windfall. Little Rock had been subsidizing those plans for years and years and years. Little Rock is finally getting their radical share.
Well, and I think that, if I can finish, I think
I'm
that's.
sorry.
No, I appreciate that, and that's a good argument. The only point I'm making is this is on the internet and everything, and I can sympathize with people who are accustomed for their funds. It's just like if we were accustomed to getting $1 million a year, and then all at once there was a legislative act, and zap, we get nothing. Now, I don't care how it's justifiable, it would be a hard pill for us to swallow sitting here at this table. And that's the boat they're in, and that's all I'm saying is, you know, it'll all work its way out, but Roger is correct, that it is a level playing field in terms of everybody.
I mean, it was a fairness issue, and that's
It
how it
was.
was able to get through. And
Well-
it truly is a fairness issue, and I don't think there's been enough time to really,
No matter what you try to make fair or what you try to make perfect, you never reach perfection. I mean, you just simply don't. Years and years ago in my community, and by the way, it's divided into 2 counties. It's actually in more than 1 county. And when you do property taxes, your local assessor determines what the valuation is, et cetera, et cetera. Well, we had an issue where in 1 county, we were on target. Our property was assessed at 20% of its market value, and we were pretty close to market value. In the next county, they were about half of what they should have been. And in one particular school district that had patrons from both counties, one set of patrons was paying their property tax at market value, the others were getting a discount, so to speak, of half. And it had been going on for 10 years. Well, when they adjusted the tax rates up to get the evaluations correct, guess who complained? The people whose taxes went up. And one of them complained to me, and I said, well, I've been paying my fair share, have you, for the last 10 years? So you're right, Madam Chair, that it is a matter of fairness. You're trying to balance things up. Just because you've done something incorrectly doesn't mean you continue to. At some point, there has to be an adjustment. And Ferris is correct, too, in that naturally that elicits a response. We need to do something about this.
Well, and I appreciate the point that you made, Sarah, when you made it, as a matter of fact. But when I say that, and listen, we have been dealing with this issue at the PRB here
For a
in
long
recent
time.
months since the enactment of it. And I've made it very clear that, you know, if you'll recall, after the legislation passed, the state actuaries projected we were going to get around $1 million. They didn't even know themselves it was going to be double that. So when I say a windfall, I'm speaking in terms of what we had thought we were going to get. It turned out to be quite a bit more, and that's a good thing, not a bad thing. But I
Well-
certainly understand folks like
And there's another piece to that puzzle that I at least should mention. It doesn't really affect you as members of the old Little Rock Police Pension Plan, but it does affect the employer, the city. And that is that the contribution rate on the lot fee side is being levelized. Okay? It won't happen in 1 year, but in a period of 2 or 3 years, every single city in the state that's in lot fee will contribute the exact same percent of payroll for their plan.
And that's
Now,
good.
their payrolls may be different, but their percent of payroll will be the same. And there are some people that have been paying less than that won't like having to come up. You've been paying way up here, yours is going to come down. So you benefit from that as
Or the
well.
increases will just level off. I'm not sure that we'll actually see it come down, it just won't
In
keep going
principle.
up.
In principle, but there's lots of other components as to whether the payroll's growing or you're doing new hires or what have you. But I think that the legislature has been concerned to try to make sure what money's out there stretches as far as possible to provide as much help as possible to every plan in an equitable, fair way. We are kind of finally to that point. But the noisiest ones that don't like it are the ones that see themselves having to pay more.
Like
And,
what you were saying about the Laffey coming down and laying off, some will come down like Little Rock, and you said probably level off, and some will go up. When will that take effect?
The state statute doesn't allow that rate to be increased by more than 1% a year on the part of lot fee. They can send out an increase to a city, say they're at 8% payroll, and then next year they can go to 9, the next year they can go to 10, but they can't leap up 2 or 3% at once. It's 1% at a time.
And
So,
ours has
Lee,
pretty-
it's starting now.
Pretty standardly gone up that 1% a year.
Yeah.
But you're saying Little Rock probably just level
Well,
off.
I mean, we just got notice that, it's going up another percent, in July. So it's still, ours is still going up. What I'm saying is, when it fully affects, maybe we won't go up a whole percent every year from that point forward. I don't think we'll actually drop down. I think we'll stop going up.
Right, it's not going to level off.
And that, there's all kinds of factors that affect that. So if the market gets really good for a period of a few years, and you don't have lost years to factor in, as you do the smoothing, then it actually can come down, because we've had city contribution rates come down in the past. We'll just have to see. The market is a player in that as well. Yes, ma'am.
How much is that 1%?
My question was going to be, when would we see it come down? I don't know if that is
It'll
Sarah's
be,
question.
I would say, if it's going to levelize or come down, it'll be probably in the cycle of the next 3 or 4 years, at the earliest.
How much
Maybe
is-
as much as 5,
I think at least 5.
but not more than that.
Yeah.
How much is that 1%?
I can't tell you how much 1% is. I'd have to go back and look. But, I think our police rate is a little over 14%, I think is what I got. Or that, I don't know, it could be higher. I know one's 14 and one's,
I did have, well, one other thing. And this goes back to the political side of things. Our governor has one more session, and he then becomes kind of a lame duck. And therefore, the election cycle in another 2 years, that seat will be open for new players. So we don't know who is going to run. We do know Dustin McDaniel will run. The dynamics of those politics, in terms of who has a majority of the House, the Senate, and who may be governor, may affect the viewpoint, the attitude toward public pensions. And you pick up a newspaper and you read about cities in California that are taking bankruptcy to get out of their pension obligations. Our state is pretty sound. Our pension plans aren't anything like what's been going on in California. And our pension plans here are very lean. We don't have real huge benefits in much of anywhere. There have been double dipping problems, things like that. The legislature's kind of trying to close some of those loopholes. But your pension certainly isn't. It's about as lean as it can be and doesn't even have a COLA. People read stuff and they think that's everywhere. They think it's universal. And some of those people get elected to the legislature. And then they want to take an attitude of being opposed to public pension plans. One of the things that I have asked of Jody Carrero, Gail Stone, David Clark, those 3 specific people, is that we need to develop what I'll call, refer to as a white paper, to show the economic impact positively on local economies from all of these pensions. So let's just use Little Rock. How many retired teachers live here? How many retired police officers, firefighters? How many retired public employees, state employees? It's a pretty good number of people. We can actually get you the numbers and show you how many dollars in pension benefits are being paid into Pulaski County in all of those plans every month or every year. It's a pretty good sized number. Your local Chamber of Commerce tells you that a new dollar of payroll or a dollar of payroll turns over in the economy like anywhere from 6 times to 8 times. And the primary source of revenue for a lot of communities is sales tax. It is the primary source of revenue for the state of Arkansas. So every time a dollar gets spent, it usually generates a sales tax, right? You buy groceries with it, we're reducing that tax, but you buy things with it and that creates a sales tax. So it helps the local economy, it helps the state's economy, it helps the revenue stream. So if you start killing off public pension plans, you would begin to shrink over time the impact of those revenues, and the communities will lose that revenue. So if we can develop something that shows clearly the financial impact in a positive way, will the legislature sit up and take notice and be less likely to do damage? We would hope so. But you gotta connect all those dots. You've gotta give them a bigger picture because they don't see it that way until you show them that. So I'm doing what I can to try to influence those people that are in those key positions in those pension plans to protect them by being able to show a clear picture of the positive financial impact. And I think in the end, if we take $1 of benefits paid out and the cost of establishing that benefit over a period of how many years? You paid in, as police officers, you paid in 6% of salary, I think, to your plan, plus 30 years. Everything else that got paid in. If we look at the actual cost to the taxpayer of that benefit versus the financial benefit each year, the benefit is far greater than the cost when you look at it that way. And I think it's time we start showing that public pension plans aren't bad. You know what percent of retirees in public pension plans leave Arkansas when they retire?
Low.
Very low. Less than 5% ever leave.
Can't afford to go anywhere.
It's, people like living in this state for lots of reasons. But we don't have a lot of attrition of our retirees, which is kind of interesting. It's a great place to live, great place to retire. Matter of fact, people move to Arkansas from other states because we have a better retirement environment than most other places. Anyway, thank you for all that time.
So our members need to shop Little Rock.
It'd be a great idea. So in your case, Lee, you especially need to shop in Little Rock.
If they need to live in
Live in Little Rock.
Thank you, Roger.
We'll move to number 7 on our agenda, the report from the funding committee. Is there an update?
Yes, we discussed today long-term goal, which is still the same one, which is Lofty with the COLA. We talked about, just like the gentleman just talked about, educating the legislature. We feel like we need to start doing some education on the city board to make sure they understand that this is a moving ahead organization, a partner with the city of Little Rock. And the first step of that is going to be that James is going to attend a board meeting, probably with one of the other board members, and talk to them about the new webpage and invite them to not only look at the webpage, but also if they would like to participate in the webpage. And I think that would be our first step towards that. We need to go ahead and gather all that information together on the courts and fines and fees, because if we want to change anything, this is the time of the year that we start looking at changes for 2013. This is when Sarah and Bruce are looking at the budget. So in September, we will try to look at any new things that we want to look at for the coming year. And so that was about our report this morning, that we want to educate the board of who we are. And I'm sure right now that if we asked the board about Lofty and COLA, that the majority of them would not know what we was talking about. Last year, I would not have known what she was talking about. So I think it's time that, we become active in the communications with the city board.
Thank you.
Director Aycock, on the, 7B, was someone going to come over from the property line? Maybe not.
The chief came over and answered questions, and I think that was addressed. I don't think, there's no further follow-up that we're aware of.
I thought we was gonna get something from Pulaski County on how they handle theirs. And I don't think that we've received that report from Pulaski County yet.
Yeah, and I think we're trying to get Ms. Fredericks from the property room maybe to come over to explain a little more detail.
We talked to the chief
We
about
have
that.
asked, and the chief, said that he had come and answered the questions.
Oh, he'd already taken care of
Right.
it for the past, so, okay.
He came and talked to us about those 3 pockets of money over there. And then
So-
my notes was that we was gonna have someone explain to us how the county can do this, and that we've not been able to do it.
Well, we need to, there needs to be a couple of questions answered here at least.
Okay.
And maybe Sarah can, I don't know, but I know one of the things when the chief was over here that we just briefly mentioned was, and it goes to Sarah's report, it shows in, we can cover it when we get there, I guess. It concerns confiscated goods and the fact that it doesn't, well, let's just wait until we get there.
All right, so are we now ready for the report from the board treasurer and acting chairman today? If you'll turn to, 8A. This is the, balance sheet for the June report, and, as was mentioned by Stevens in their presentation earlier, the value of the assets managed by Stevens as of the end of June was, $41,668,015. The total plan, value was $42,724,305. The difference being the portion of cash that's in First Security Bank for benefit payments. The drop balance was $22,109,113 as of the end of June. On the next, sheet, you'll see the income statement. The revenues for the month were $216,566. There was, almost 21,000 in, fines and police clearing, property tax of about 145,000. Now, your supplement checks, the police supplement, the future supplement, and the new, replacement for the guarantee fund, those checks were all received just yesterday. So they are not reflected in your June statement, they'll show up in your July income report. And, we did receive those amounts as we had, presented at the last meeting. We had received notification of what they'd be, and they did match up. Benefit payments for the month were $602,000, 3.6 million year to date. Drop disbursements this month, $610,791, and a little over $2 million year to date. So the net loss for the month after drop was $996,967 and 3.6 million year to date, and that's before any investment returns. The investment returns for the month, as Stevens mentioned, we had a good month in June, was $778,878. Year to date, 1.9 million, almost $1.9 million, well, a little over $1.9 million and a half. So, definitely positive returns year to date. But, again, benefit payments are exceeding those contributions. So the loss for the month is $218,000, and the loss year to date is $1.6 million. Again, if you look up at the drop benefits paid out, that was over $2.1 million. We're at the midpoint in the year, so you can see on line 3, the city sales tax contribution, that's at $250,000, so half of the promised sales tax has been deposited to the fund. As we turn to the next page, you'll see your non-benefit expenses. The biggest was the annual audit fee, and this is the allocation to the fund each year for the annual audit fee. And, so the total for the month was $11,816, $8,100 of which was the annual audit. Attorney's fees, month of June, there were none, so we're still at $930 year to date, which is a big improvement over last year.
Good.
So that concludes our financial report. I'll entertain a motion to approve it.
I make a motion to approve the financial report.
All in favor?
Aye.
Opposed?
Do have a question?
Okay.
Under, that's what I was referencing just a minute ago, under line 12, confiscated goods.
Yes.
The column that is headed with 12/31/11, is that the 2011?
That's the
total?
2011 annual total, and year-to-date, it's $18,878. And I think when we asked them about this at the beginning of the year, you know, they didn't auction those on a regular basis, they accumulate and then auction, and so it appears they've had more auctions so far this year than what they had last year.
Well, I mean, to me, the 3,000, nearly 4,000, boy, that seems low. I mean,
Well, and I think that's what made you start asking those questions, and they came and responded. Y'all asked questions, and they came and responded as to how that's handled, and clarified what goods they can auction, what they can't, you know, and so they just didn't have a lot of property that was available for auction, but they've had more this year.
Are they still using, do you know if they're still using, I don't think we asked that question, the online auction?
Yes, they are, and they did respond that they are.
They told us they was using one out of four.
One point that he did make was he said that they had to accumulate so many longer
Right.
before they could pick them up. 150.
So they did come and address that, and the good news is, I mean, we're 6
Good.
times what last year's was so far this year's.
Okay.
Okay, so the report was, approved. Now we'll move to, changes to the rolls. And we have, a retiree to add to the pension, Robert Lund. And I'll circulate this, the amount's $2,133.54. So there's, circulate that.
Did I sign that?
Did you sign on the back page?
No.
Okay, I think that,
Sorry.
Turn that
I signed under Robert.
Did you sign Robert?
How long have you been a pension member, Ferris?
I am
maybe you can
getting
stay
old,
seated up there.
60 years.
You put this
Where
on.
is the sheet on the?
Show them
here
where
we
to
go.
sign, Kathy.
I guess need a
Yes,
motion
I-
for Robert,
motion.
make a motion to approve the retirement application for Robert Lust, effective 7/28, monthly amount
I don't know why he didn't
21/33/54.
Thank you. It's been moved and properly seconded. All in favor of adding Robert Lust to the pension rolls at a rate of $2,133.54, please say aye.
Aye.
Opposed? He's been added. And then there's your update on Mr. Dean Garrett. We did receive another $150. Her balance is now $40,985, and that issue's been tabled. So, I don't think there's any further discussion necessary there. So that concludes the report from the treasurer, report from our website facilitator.
Okay, the website's been active since June 11th this year, and we've currently logged over 5,400 hits, which I'm just extremely pleased with. We've got a lot of activity, got more and more members signing up every day. You don't actually have to register to comment, but you do have to have your first comment approved by the website facilitator. And I'm extremely pleased with the number of hits we've had so far. The highest number of recorded hits in one day was 518. And on this particular date, I posted 3 articles. I posted the 2012 captain's list, tips to beat summer heat, and the LRPD dispatch link, which I think a lot of members you know, even though they're retired police officers, they still from time to time like to reflect back. Bobby, have you had a chance to listen yet?
No.
I know, I go back and I hear the same thing all day long, units that can take a call. You know, so they're constantly looking for people to take calls.
Things have not changed.
It hasn't changed one bit. Members are constantly emailing me, like I said, talking about the positive atmosphere of this website. And that's one of the things that I'm hoping to continue. I'm constantly on the news outlets every day looking for positive things to post. I'm gonna ask members of the board, if you've got anything that might be of interest to the membership, please forward that to me. I know, I talked to Ms. Joan a little earlier, she's gonna give me an email on some things that I'm gonna post. Any other board members?
Well, I think the special election would be a great thing to post.
Yes, ma'am, that's exactly what we're gonna do. Exactly what we're gonna do. We're one step ahead of you, Ms. Jones on this. So.
All right.
But any information you guys get, anything that might be pertinent to the membership or that you think is newsworthy, please forward that information to me, because I find that I'm spending about 3 or 4 hours a day just searching different news outlets trying to find information. And I'm putting a lot of different things on there. It's not just pension related. There's some help things I'm putting on there because I want the membership to understand that it is important. In order to receive this pension, you got to be alive. So you got to take care of your body. You know, if you're not eating right or you're not taking care of yourself properly, you're not going to be here to collect that pension. So I do a lot of health related stuff, a lot of different topics. I got a really great email last night from one of our pension board members, his wife. And in her email, she said that normally she's just a lurker on sites like this. And I get a lot of lurkers. You know, they come, they visit the site, and they don't really say anything. Well, yesterday she decided that she wanted to let me know in an email, and it really meant a lot to me. Because when I get those emails, what it does is it gives me that positive reinforcement to go on and keep doing what I'm doing. So I really appreciate all the board members and everybody else who go to the site and say positive things, because it shows other people that are coming to the site that there's dialogue being exchanged and that this dialogue is positive. I did have 1 or 2 that were concerned about some negative connotations, but that's been dismissed and everything's just awesome.
Great. Well, I think you're doing a great job with it.
Thank you.
I'm one of the lurkers.
Oh, you're a lurker.
Yeah,
I'm a lurker.
Thank you.
Wow.
Okay, well, we had moved up our fund member comments, so we're on
I've got
to-
something though, probably
Okay.
something along that line. You know, each of us, I guess, reached a point in our career where, you know, coming to the end of it. And I've been approached, this kind of goes back to what Stevens people were talking about, as far as people getting their best sunshine pump out and giving you stories about what they can do with your money. And it gets confusing. And there's members of this fund that have called me or contacted me at various locations and asked why, you know, we didn't get any money on any return on our money, the drop money for last year, and even discussed the previous years. And I think the only way it's gonna go is up from where it's at. I mean, maybe we got 0 last year. I'm hoping that it will. The thing that I think is important, that I'm a member of the drop, however, you know, to actually think that I don't care about the other members of the fund is kind of a strange thought to me. Is it the money that is in that drop fund? It serves 2 purposes. First of all, it allows the member to save some money, be able to use that money otherwise later in his life. The other function that it serves is to put that money back into the pension fund as a whole to be invested. Therefore, the more money that's invested, the more money that comes back to the fund. So it's actually benefits.
Well, and the reason that I think Jody's study proved out that overall through history it was approximately break-even but slightly beneficial is, again, because of the fact that you're being credited with 2% less than the top. In really good years, the fund benefits from that. In years when there are big losses, then the drop member has some safety and the fund loses a little bit. But overall, through time, he was able to show us, and again, it's before the big recession, that drop had been slightly positive. So, you know, I think that the question, and I made a note of it, that Larry said is, you know, how does that impact change as the percentage of the portfolio that's in drop increases? And that might not have been answered really in the previous study.
Well, I guess what I was getting at mainly is we've all got to make a decision, the people that were on the drop, we've got to make a decision ourselves as to what we do with that money that's in there. When we get to that point, do we go ahead and take the money out with the, you know, the glorified promises that were given by several people with money managers and marketers that are approaching us whenever they know that you're getting to the point where you're gonna be able to take it out? Or do we leave it in there for the purpose of benefiting the fund as a whole? I'm assuming there's about $1 million taken out last month or something along those lines. I heard somebody say that. You know, and I want to make it clear that if you keep taking money out of that, it's going to be detrimental to the fund itself. Well, versus leaving the money in there and letting it try to do some good through Stevens for the fund.
I'd like to say one thing on that also. I was over there at the legislature when this drop rule law was passed, and Chief Caudell came and addressed that subcommittee at the time. And he said that Little Rock had an average of 21.5 years retirement. When they got 21.5 years, they retired and went on to work for the sheriff's department, the law enforcement agencies, and he lost his seniority on his police officers. And he asked that subcommittee to pass that drop law so he could retain his senior officers for Little Rock PD. So they did, and they retained senior officers and senior people to continue employment with Little Rock PD. He's losing some of his best homicide investigators, he said in the statement. So they did pass a law, and the members did make that decision to stay with Little Rock PD and not go out and get another retirement system through ACRES, through the sheriff's department and others, like some of them did. So this is the only retirement system that most drop members have, is this pension we have to fund now. And that drop subsidizes a little bit for a while, but eventually it goes away.
Mm-hmm.
And the main number one concern is our pension. And I think that's every board member's number one concern on this board, is that original pension. And that's what we're here for.
Thank you.
On other business, I just did want to include, I think Ferris had asked Jody to have some information in a letter to Mr. Moore, and that's attached at number 11. Basically, in reading it, my understanding is he's thinking that it probably would not be worthwhile for the fund to incur the expense of an additional study. He doesn't think that it would result in any kind of a significant change in the results that he presented before. And so, you know, he put what the cost would be. I think that we could ask him if, without going into a great detail analysis on each, you know, on the drop accounts or any history, just a general statement of the how the impact changes as the percentage of portfolio and drop increases. We could ask that, but I'll leave it up to you what you want to do. I think he indicated that would not be probably a wise expenditure of funds, that we would spend money and not get a very different result than what we've already received.
Mm-hmm. Well, maybe we were on, different sheets or something, but, and I had received, the request from the member, in fact, on the website to ask Jody to maybe include this very issue in his upcoming report.
Oh, and he did tell us that the upcoming report, because we asked him to receive the fire one and we had not received the police one yet, and he said it would probably be another month or two.
Mm-hmm.
He said probably September, I think.
Yeah, right.
Well, and what I had done, I had called him, and we visited on the telephone for a bit, and I thought that's what we had decided to do, was just simply ask him to not do a separate study or incur additional costs, but to simply cover from an actuarial perspective basically what he's already covered, or to update it with anything that he may be aware of since then. No, I don't necessarily think we need to incur a couple of $1,000 expense. I think that he can explain.
Would he be able to explain with an additional $500,000 added to that?
No, now my understanding is, am I off on the wrong page again? I thought the additional cost would be just drop, I thought that's what you were talking about.
Around 1,500?
I hadn't read the letter, we just got it today, right?
Well, and actually, I saw an email where he apologized. He did reply and included you, but he had your wrong email.
Ah.
So it bounced back.
It's my understanding that the letter is 1,500 for drop and it's 2,000 for the consolidation. So if we don't have a report saying what an additional 500,000 do, we won't really know anything, will we? I mean, he can't report on anything else other than what he's already reported. I'm just asking.
So you're saying after, and again, he couldn't do anything, I think, until after the actuarial evaluation is complete
Right.
for the current year.
Right.
But then you're wanting him to do another plan that shows different contribution scenarios and how that would affect the timing of the drop with
Right.
merger.
How would
Or
return
the timing of a merger with
merger
Lockheed.
with Lockheed?
Well, I thought that's what we've been waiting all these months for.
Well, I mean, have you all already asked him to make that report?
We did in the last meeting he was at,
We-
didn't we?
I think it was gonna come, he said, I think in the last meeting, when I did minutes, I think he said he was gonna send Mr. Moore a letter and ask us to make a decision on exactly what we wanted. We threw out a lot of
Yeah.
other things to it, is that right?
I think that's right. I think he needed clarification, but he also needed to have the updated actuarial as a base for anything else he did.
And when does that gonna be?
That's what we're saying, September.
It won't be in September, so we shouldn't do anything right here until
Right.
we get that in September.
Right.
I got you, okay.
Well, now
If you
is,
look at that 1, 2, 3 on the front page,
huh,
turn the page over. Here's 1, 2, 3. Is that what we asked for?
what he's saying here, for the record, updated estimates of the likely consolidation cost. We did discuss that. Two, the variations of that cost amount under various amortization schedules that could be suggested. We did discuss that, for example, the additional 500,000, what impact that would have. And three, a discussion of what reasonable amortization methods for this type of liability. And I think what he's referencing there is currently unfunded liability is expensed or amortized, if you will, over a 15-year period. That's a lofty rule. And what we had asked for during the meeting, and Dave Clark, the director, is also here, was to maybe explore what impact extending that to maybe 20 years or 25 years would have on the cost to the city to consolidate. Now, while recognizing that Lofty is in control of whether they let you do it or not, we could certainly ask them to if it had a significant impact in terms of lowering the cost.
And didn't Mr. Clark say that he would look at that, the board would look at it?
Yes, but I think what we had discussed there with Jody was for him to include in his report that, I think. So, I guess.
So do you feel like this is an accurate reflection of what you asked him to do?
Yes. The question remaining then, again, I hadn't read through all this, would be the additional whether or not the board thinks it's reasonable to incur an additional cost of $1,500 for him to relook at the drop. Now, again, I hadn't read, I guess it's a study.
put this back on the agenda for next month?
Give everybody time to reflect, and again, since the report's not gonna be ready, there's not any urgency, you know, I mean, he has to finish the actuarial before he can move forward, so we could address this again on.
And that'd be September. So we have another-
Well, I would only give him one month. Could I, if I can do this without being out of line, would you mind calling Jody? And the reason I'm suggesting this is because I'm a member of Drama. You're not. So maybe it would make some members feel better if you discussed it rather than I, but to find, I hate to incur a $1,500 cost if it's not needed. If it is needed, then we need to do it, because we have to answer questions, that's my opinion. But to see if he could, if something, I guess what I'm saying is, if, he can do some kind, if we really do need a full-blown deal like this or not.
Well, and I would imagine you're probably gonna post this letter
Yes.
to your site so that members can actually see
Yes, ma'am.
how he's responded. And I'd be happy to call him and, but it sounds to me in the letter, he does not believe there would be a significant change
Sounds
in the result. And so, and in fact, in the email that he sent attached to the letter, he did not recommend incurring that cost. So, you know, I'll ask him if the idea that the, you know, percentage of drop in the portfolio changes that opinion in any way. You know,
Yeah, and I mean, that's month after next, it's not, it's like it's very far off, and he can address that without the study, and then if we think that, I suppose that there needs to be a further review of it, then we could do it at that time, I suppose. I'm just rather sensitive to, you know, the
So
issues.
I have a couple of issues.
okay.
The first issue, under number 2 of your agenda, I know some of the boards and commissions that I sit on will also announce at each meeting that this meeting is being recorded, both video and otherwise, and it will be shown on the webpage. That way that notifies anyone that's planning on speaking that it will be shown.
Okay.
So if
Under
we-
number 2 on the agenda?
Besides notification of news media, then the notification of the, meeting being taped.
Okay.
And it will be available, the complete meeting will be available on the website. That way anyone coming in will know that, it will be on the website.
Sure.
And secondly, I have asked, Mr. Arnold, Officer Arnold, to also include on his webpage the City of Little Rock's public meetings for the infrastructure, and this is a result of the sales tax. And I've asked him to please put that on the webpage. Also, I have, Mr. Moore's presentation that went before the board on the millage, increase or millage, extension. And I will give you this, I will also do a narrative about this that you can put on the webpage. Not asking any votes on it, but also we want to educate the citizens as well as all members of this board of what the importance is of both of these meetings.
Yes, ma'am.
Thank you.
We'll do that.
Any other business to come before the board?
Just one more thing, and a member had contacted me, and quite honestly, it's not something that directly, obviously, or I guess that part indirectly this board controls, but it is something that I know that is of benefit to members, some members, and it's an issue that I know the city cares about, but, and I didn't know how to answer it. You know, once we become, for members who took their city insurance with them under the formula, and when they become Medicare eligible, they have to get off city insurance. And I don't know a lot about this because I'm not there yet, but this member explained to me that obviously when you drop medical, they require you to drop dental and optical also. And the question in his mind that I couldn't answer was, you know, why do they really require you? You can understand the medical end of it because that's a cost to the city, but the dental, it's not like older people have more dental issues than younger people, or that they have, we run up here. So his deal, I know that's true with me, I've had dental work done going back, but I don't have any done now. There, it's all done, see? Thing. But, anyway, this is the question, I'll reserve it, if we could put it on the agenda for the next meeting for Bruce, is to look at that, and if it's a direct cost, then we understand, but if it's not additional cost to the city, it would be nice to let them to go ahead and just carry the dental and the optical, if it's not going to be a cost to the city.
I was gonna put it on the August agenda, because, Mr. Moore asked me, I asked him about the non-tobacco discount, and he said, well, he'd put it on
I think you
discuss
asked
it.
about that before.
He wants about 9 times. He said, 9 years, past 9 years, he said that he would, discuss it in August, and reevaluate it, so I was gonna put it on the August agenda, and go, future, I'll do that, I'll include that.
Thank you, appreciate it.
Okay, Roger, again, there's something else?
Yes, ma'am. I don't know that it'll be on the city board agenda between now and the fall election. One of the constitutional amendments has to do, I think, with incremental financing and something that's been referred to as the STAR bond program. In that constitutional amendment is language that would allow cities to do a bond issue for merging paying off their old plan debt, whether that be police or fire. And it's very, very important for that to pass, at least I think so, because that's the difference between what would look like an ARM mortgage and a fixed mortgage. Currently, when you merge a plan, you end up with an amortization period, and based on investment returns, various things, your actual annual payment can go up, and it has for a lot of cities that have merged. If you can get a bond, you just pay off your debt, you're done, you're finished, and your bond payment is fixed. And you pay it off in however many years the bond was for. So the cost to the city is reduced substantially, which means it's easier for a city board to go along with merging a plan if you can get fixed financing. It's a lot of money, savings, if you can do one way versus the other. And because of accounting standards, when they calculate your liability when you merge, the way it's done now is based on those accounting standards, and you really aren't allowed to go out and do a bond. So Stevens was involved in crafting this legislation, and it's kind of twofold, but it's for cities. The idea being that if this passes, cities can do incremental financing.
Yeah, but that's on the November ballot, right?
Yes, ma'am. So
Okay.
my point would be whether the city board is brought up to speed on that before the election, if that becomes an agenda item for the city board to discuss and take a position on. It should also be something that you all probably at least touch on here.
Is that not SJR 5?
I think it is.
And that's also has to be voted on by the taxpayers?
Well, if it passes in the
passes.
fall,
Yeah.
you would still
All
always
that
have to
does
take
is
it
make
to the
it
taxpayer.
legal to do it, but then you would still have to have a separate election.
Separate election
To do
after
a
that,
bond,
separate
right.
election.
Would you please ask
Good.
Elise to circle back and have that discussion?
Yes. Thank you. I just wanted to bring that up, make sure you thought about
But
it.
I do think the municipal league is in support of this.
The thing is, Lee, that they should be, and they probably are, but there doesn't seem to be any excitement about, gee, we need to try to get this passed. And the interest is very lackluster. And it could just slide by without anybody even noticing. And but if that happens, there'll be a lot of people that just would be opposed to it because it has the word tax in it. You know how that goes.
So if
Sarah,
it
Sarah will get a report from O.D.S. Wilson to the city board, and then we'll see if we can endorse that with the municipal.
I mean, it's your all's decision, but if it does pass, it gives the city a tool that they currently don't have. That if they ever exercise that, get the voters to approve it locally, it's a cost reduction, makes the merger much easier. That's all.
Anything else to come before the board?
Did we touch on this resolution for surviving spouse benefits, or did we miss it?
Yes, we did, she,
We're still in the process of looking for that resolution. because the recollection of this, of the membership is that y'all passed that already, but we can actually find that resolution, but it's possibly combined with another benefit increase. So Kathy's continuing to look for that.
It was, I mean, if it was, it was.
Well, and today, one of the things we discussed was following up with the PRB to see if they had a record, because we think it was done at the same time, potentially as a benefit increase. So, anything else?
I'll make a motion to adjourn.
I'll second that.
All in favor? Opposed?
Let-
Okay, meeting is adjourned. Y'all did not do near as well this semester as last time.
I'm disappointed in y'all.